Hey everybody, it's Kevin from Leading Edge Financial Planning. I'm going to talk about the first quarter of 2019. As always, we believe in long-term investing. We don't believe in trying to time the market. It's the time in the market, if you will, as opposed to trying to time the market. But we like to use the quarter returns to get across a few messages, things that we learn, themes. So the first theme is we were right, we were wrong. Okay, so during the final weeks of 2018, we had a lot of people reaching out, just concerned. It's very natural. Markets were going down violently, and we said to hold on. So a lot of people online, they will say, I was right. So before we take any credit for it, this just has to do with our investment process, our humility as investors, as investment coaches, managers, whatever you want to call us, and a plan when things go bad. So we planned and were ready when things went bad in 18. So it turned out that, it was great to hold on. But going forward, we could just as likely be wrong in a short period of time. So I would say we cannot pat ourselves on the back. You as investors, we as investors, we can't. We just as likely could have been wrong in the short run. And still could be wrong. 2019, we're now, this video is being made on April 11th. Who knows what's going to happen for the rest of this year? The key thing is to have a plan and to stick with it. Have a process and stick with it. That's the key. So did anyone sell at the beginning of Q4 and buy in the first quarter of 19? That would have been the strategy. And I'm going to share with you why that was so hard to do so, using the actual days of the year last year and this year. The next thing is that good can follow bad, bad can follow good. So just because prices are going in a certain direction, that old random walk down Wall Street, doesn't mean they're going to continue to go bad, but bad also can follow good. It's, again, back to humility and having a plan. Price movements are moments in time. So that's one of the things that we talk a lot about. When markets are down, we say it's a moment in time. Let's not allow this price to freak us out. But the real question, I guess many people ask themselves, is which is the right price? Now that the markets are back up again, is the price right now or was the price right then? And in moments in time, you can have moments in time when prices are great. Well, again, we believe, and I'll show you a chart that shows that investing in a prudent way and going through the process of waiting for returns to show up, it's not a guarantee for positive returns, but we think probabilistically speaking, it's the best way to do it. And then finally, discipline hurts. And sometimes discipline's going to be wrong. Now, we were disciplined in 2018. We did not sell. But there's going to be times when you're disciplined and you're going to say, well, why the heck are we disciplined? Dogmatic and discipline are similar words. In investing, though, you have to have a belief. You have to have a religion. So here's what showed up in 2019, the first quarter. Here's the returns that showed up. So the U.S. stock market was up 14.04%. Average returns are here. Markets almost never hit the averages, but these are the average returns for a quarter. International developed was up 10%. Emerging markets was up almost 10%. Global real estate was up 14%, and then both bond markets were up 3%. So fantastic returns in the first quarter. If you got out last year in the fourth quarter, you missed this opportunity when these returns did show up. Now, longer-term returns, the 1 year, we still know that foreign markets are still down over the last year. So that's April 1st of 18 through March 31st of 19. Global real estate, U.S. stock market, bond markets are up almost 5% over the last year, in spite of the fact that interest rates were rising and everybody said it was going to be damnation for bonds. And so again, humility is important. We look at 10-year returns, and these are not expected returns for these asset classes. If we look, and this is where data can totally trick you. Statistics can lie. Okay, so over the last 10 years, 16% return for U.S. stock market. But what we're talking here is we're talking at the very bottom of the Great Recession. Now, that's the 10 years we're looking at. March 31st, 2019, going back to April 1st of 2009. The market bottomed, was down 53%. The market bottomed in March of 2009, and that's the reason why these numbers are looking so extraordinary. I worked then, and I only had one person that put money to work in March of 2009. They put $50,000 to work, and I was like, wow, that's great that you're doing this. And they said, do you think the market is going to go up from here? We said, we don't know. It's sure a scary time, but things are lower now than they were a year ago. So anyway, 8%. These are both about 9%, I'll say, and global real estate has been 15% for the same reason I mentioned. Global real estate was down. Bonds have done pretty well over this time period. So this is the worldwide and selected headlines. You can read these headlines in the first quarter of 19. What's so interesting to me about the news and headlines is that you would think headlines would drive market performance. Actually, I think many times that if markets do well, the headlines are more positive. Here's the last 12 months. And again, the funny part here is that the headlines were super bad in the fourth quarter. So here was one of my questions. My question was, on September 30th, did you sell? Okay, now we just gone through a fantastic first 3 quarters of 2018. The news was extremely positive. I took a vacation around here, and I just remember thinking, well, everything's going great this year. Thinking, well, it's probably going to be a great year. And then all of a sudden, wham, the bad news, well, not even the bad news, the markets just started going down and started violently going up and down here, and then kept going down. And so is an investor able to sell when everything is going great? Heck no, it's hard. You want to buy more. And then December 24th was the bottom here, and markets have come back. And so again, you can look at the headlines, but the headlines were really bad once the market started going down. And we have pretty much the same world and same news stories right now, but they're not reflected to be as bad. So here's the next question. On December 24th, 2018, a moment in time, if you paid attention, the market seemed very risky. Okay, December 24th, the market was down. Peak to trough for the world market was down more than 20%. For the S&P 500, it was about 20%. These numbers are just as of January 1st. The peak to trough would be from here to here for the S&P, and for here to here for the world markets. So big, violent downturn. Seemed very risky. A few people wanted to sell. Some people said it was a good time to buy. We said, let's just stick with the plan. Now in 2019, all the market's done is go up. The S&P 500 is up and the world market is up. So I guess the question I would ask is it okay now? Is everything good now? Is it time to start throwing money in again? Well, the market on December 24th seemed very risky. The market right now, again, is calm. I don't think there's a difference in the risk profile. Markets always can get unhinged. They can always go down 50, 60%. Great Depression, markets went down 80%. They can always go down. The risk is pretty much always the same. Now, if you buy higher and the valuation in the stock market and all that stuff, I get it. But there's always risk. And so our fundamental belief is, again, let markets work for us. These are the returns since 1926 of small cap, of large cap, of long-term bonds, U.S. Treasury bills, and then this is inflation. Let markets work for us. There are these times of violent correction, but if we hold on to the companies that produce diapers and medicines and heat our homes and run our smartphones, if we invest in these companies and companies continue to do well, the population increases, more stuff is sold, more services are used, our world gets better. There's lots of people that say the world is getting worse, but for many people in the world, in many emerging markets, they now have a house, they now have one car. I mean, so if companies are selling stuff and you own the companies, you get to share in the profits. And so over long periods of time, that has probabilistically been a very, the probabilities have been excellent. And so why fight that, and why try to time the market? So here are the different asset classes. The Dow Jones U.S. REIT market was outstanding, almost 16%. Russell 2000 is small, so small caps beat large caps, and this is the S&P 500. And then you can see some of the foreign markets. Bonds, the bond aggregate was up almost 3%, and short-term bonds were up about 1/2%. So the different types of asset classes within U.S. stocks, small growth and large growth, were really the outperformers in 2019 Q1. And then you can see the others going down here. Now the world markets, the amount of money that's invested in world markets, 55% of that money is invested in U.S. companies right now. International developed, 34% of the money is invested in international developed marketplace stocks. So once again, growth beat value, and small cap beat large cap. Not by much, but and the currency this time around, currency did not kill us as it did one quarter last year. So currency was a net negative, but not by much. Okay, emerging markets. Growth beat value, and this time large beat small. 11% of all world markets are made up of emerging market investment. Still for the last year, emerging markets have been pretty poor. Emerging markets should have higher returns. They've not had higher returns over the last 10 years. Is that going to change in the next 10 years? We don't know. But we still believe owning emerging markets is important. So as far as the countries that did the best, Hong Kong is the champion in developed markets, and Colombia, 25%. Now, we don't believe in investing in single countries, but again, sometimes this stuff is interesting. Real estate investment trusts. Wow, what a quarter. I will tell you this. The stories last year that we heard was interest rates are rising, REITs are bad. Interest rates are rising, REITs are bad. And what ended up happening in the first quarter is bam, U.S. REITs as well as foreign REITs did very well. They've done very well over these periods of time. And we do believe owning a small amount of real estate investment trusts, or it's really commercial real estate. Fixed income. Well, we've just had the inversion of the yield curve. That means shorter term stuff it pays you more than long term stuff. And it may predict a recession, it may not. But if we do have a recession, if you have a long time horizon, it'll just be a moment in time. Global fixed income, the only reason I showed this chart is it is kind of interesting that there are still countries such as Germany and Japan, when you loan your money to the government, they actually give you back less money than you gave them. Negative interest rates, still kind of crazy. The impact of diversification, we talk about this all the time. Pick a diversified portfolio that you like, that also matches your financial plan, and then stick with it. We've had some people recently with the market returns being so fabulous say, I'm 60-40, I think I want to go to 80-20. And then the fourth quarter of last year happened, and they said, thank God we didn't change the portfolio. So it's all about finding your risk score and finding out what your financial plan can handle. The last part of this, and again, we're going to send this as deja vu all over again, a great yogiism, and it's just the fact that there are always things that are hot. We had the dot-com bubble, now we have FANG. Internet is extremely hot still. It was hot in 2000. Now we have new things coming out and IPOs coming out, and our belief is that, yes, there's going to be fads and there's going to be times that people make a ton of money, cryptocurrency. But if you have a process, if you invest over the long term, just like Warren Buffett, you can capture the returns that capitalism brings and world companies bring to us as investors. So thanks so much for watching. If you have any comments, questions, please reach out to us, and we appreciate you. Thanks.